Welcome to This Explainer. I'm really thrilled you're here today because, well, we've got a truly fascinating puzzle to solve. We're going to unpack the financial health and the strategic future of an absolute titan in the retail space, Lowe's, the $86 billion home improvement giant. But we aren't just going to skim the surface-level numbers here. We're putting on our analyst hats and evaluating this company through a really strict Warren Buffett-style value investing lens. So we're looking for four key things: an understandable business, a durable economic moat, an able and honest management team allocating capital wisely, and ultimately a sensible margin of safety. Get ready, because the way Lowe's is adapting right now offers a literal masterclass in corporate resilience. So let's just address the elephant in the room right off the bat. Is the home improvement boom officially over? For the past few years, we saw an absolute explosion in DIY renovations. But today, the landscape looks radically different. Without healthy housing turnover, meaning people actually buying and moving into new homes, those massive, big-ticket DIY renovation projects that usually happen right after a home purchase are simply drying up. That discretionary spending that fueled so much growth is taking a major backseat, and it's forcing massive retailers to completely rethink their playbooks.
And honestly, it really all boils down to this one number, 3%. This brilliantly illustrates exactly why the market has slammed the brakes. Millions of American homeowners are currently locked into pandemic-era mortgage rates hovering right around that 3% mark. It's created this massive, incredibly stubborn macroeconomic headwind. Think about it. If you hold a 3% mortgage, there's almost no way you're going to sell your home and take on a new mortgage at 6 or 7%. This mortgage rate lock-in effect has effectively frozen residential turnover, completely altering consumer behavior and the traditional retail wealth effect.
Which brings us to a phenomenon that industry insiders are now calling the Great Housing Reset. It's a pretty wild paradox when you think about it. On paper, home equity is at absolute record highs. Homeowners are sitting on a goldmine of value. Yet housing turnover is sitting at historic lows. Consumers feel wealthy, but because they're locked in, they aren't going anywhere. Instead of moving, they're choosing a stay and remodel path, but in a very specific, different way than before. Understanding this reset is absolutely crucial. It's the master key to understanding Lowe's entire corporate strategy heading into the rest of the decade.
Here's how we're going to break this down today. 1. The housing market freeze. 2. Q4 earnings surprise. 3. Pivoting to the pro. 4. Capital allocation. And finally, 5. The 2026 outlook. Let's jump right in. All right, Section 1, the housing market freeze and how they're navigating this macro environment. We talked about the lock-in effect a second ago, but here's how it's actually hitting the balance sheet. Because people aren't moving, we're seeing a severe move-in drought. But remember all that record home equity? Homeowners are definitely tapping into it. In fact, there's been a massive 29% year-over-year spike in home equity lines of credit, or HELOCs. But here is the major shift. Instead of blowing that money on high-margin aesthetic upgrades, fancy outdoor living sets or top-of-the-line decorative lighting, spending is shifting entirely toward unseen essential home maintenance. We're talking rough plumbing, electrical work, and structural repairs.
Moving on to Section 2, that Q4 earnings surprise and a deeper financial breakdown.
Look at the sheer resilience of their top line right here. Net sales jumped 11% to a staggering $20.6 billion for the quarter, up from $18.6 billion the previous year. And even more impressive, comparable sales grew 1.3%. In a frozen housing market where discretionary spending is supposedly dead, Lowe's somehow defied the backdrop. This was heavily supported by strong online sales, home services, and a really robust holiday performance. Meanwhile, their adjusted diluted EPS held relatively steady at $1.98.
But okay, as rigorous value investors, we have to look for the red flags, right? And here's one we just can't ignore: margin compression. Their standard GAAP operating margins dropped significantly from 9.87% down to 8.30%. Consequently, GAAP diluted EPS fell to $1.78. Why? Well, primarily because of the sheer costs associated with doing business and making strategic pivots. Specifically, Lowe's absorbed $149 million in pre-tax expenses tied to their recent acquisitions of Foundation Building Materials and Artisan Design Group. So yes, revenue is up, but right now it's costing them a lot more to actually generate it.
Okay, Section 3, pivoting to the pro, or what they call their total home strategy. Those acquisitions that squash the margins, they weren't accidents. They were highly calculated investments. Management is actively shifting the business model to survive this DIY slowdown.
If you walk through a Lowe's today, the discretionary categories like high-end aesthetics are just underperforming. The everyday DIY consumer is feeling the very real pinch of inflation and high credit card debt. They might fix a leaky pipe. Actually, scratch that, they have to fix a leaky pipe, but they are absolutely holding off on that $5,000 backyard remodel. So to combat this, Lowe's is aggressively shifting its focus away from discretionary DIY spending and toward the folks who are actually doing the essential maintenance, the professional contractors.
Let's look at how they're actually executing this so-called total home strategy. It's basically a multi-pronged attack to steal market share. First, as we noted, acquiring FBM and ADG directly expands their footprint in professional building materials. Second, they're leaning heavily into tech with an AI-enabled Pro Companion tool to help store associates anticipate contractor needs before they even ask. Third, they've completely relaunched My Lowe's Pro Rewards to build deep loyalty. And finally, they introduced Milo, an AI virtual advisor. They aren't just selling hammers, they're building an entire digital and physical ecosystem explicitly designed to make the contractor's life easier.
And this is a massive point for anyone evaluating the underlying quality of this business. This professional focus, it acts as a vital floor for Lowe's valuation. Think about it. Why? Because while DIYers hit pause on projects the second consumer confidence wanes, essential home maintenance cannot be deferred forever. Roofs leak, plumbing breaks, electrical systems need updating. As long as pro contractors remain busy with structural maintenance fueled by those HELOCs we talked about earlier, Lowe's has a durable economic moat that strongly protects its downside. Which leads us perfectly into Section 4, Capital Allocation and Returning Value. A truly great business isn't just about generating revenue. It's about how an able, honest management team allocates the cash that the business generates. We really want to do a Buffett-style evaluation here, looking at management's ability to consistently return high-quality capital to shareholders, even when the macro environment is tough. And honestly, this is a beautiful sight for a long-term value investor. Despite the margin pressures and those heavy capital investments into acquisitions, management maintained an incredibly healthy and secure dividend payout ratio of just 39%. That means they paid out $2.6 billion in dividends in 2025, while still safely retaining 61% of their earnings to reinvest back into the business, pay down debt, and weather the economic storm. It's a huge sign of a highly disciplined, shareholder-friendly management team. So the crucial takeaway here is this number, 17.45%. That is Lowe's 5-year average annual dividend increase. They aren't just stubbornly paying a flat dividend, they're aggressively growing it. Over the last 5 years, they have bumped up their dividend every single year. For a value investor looking for consistent, predictable, high-quality returns, a nearly 17.5% average annual dividend growth rate is just an incredibly attractive metric. It speaks volumes about the underlying cash-generating power of their core business model. Finally, Section 5, the 2026 outlook, and preparing for the eventual thaw. We've seen how they survived 2025, but investing is all about the future, right? What is the intrinsic value of Lowe's based on their forward guidance, and how are they prepping for the eventual housing thaw? Well, to maintain some objective context, we have to look at the broader industry. According to Visible Alpha consensus estimates for Q2 2026, Lowe's is expected to see pretty modest growth in sales, about 1.7%. Contrast this with their main competitor, Home Depot, which is projected to see a 4.9% increase. Now, it's super important to note that Home Depot's stronger forecast is heavily aided by their massive $18 billion acquisition of SRS Distribution, which gets them deep into roofing and landscaping. But it does show us that Lowe's is actively projecting a much more cautious, stabilized path forward, rather than betting on explosive growth. And that caution is really clearly reflected in management's official fiscal 2026 guidance. They're projecting total sales between $92 and $94 billion, with comparable sales ranging from completely flat to maybe up 2%. Adjusted operating margins are expected to be tight, hovering around 11.6 to 11.8%. Essentially, what management is signaling to the market here is that growth is largely going to be stagnant until the broader macroeconomic picture changes. Specifically, until the Federal Reserve potentially lowers interest rates below that magic 6% threshold to finally unlock the housing market again. But despite those fairly conservative numbers, I absolutely love this candid communication from CEO Marvin Ellison. He stated, "Whatever the macro environment provides, we expect to outperform it." That is exactly the mindset you want from an executive team during a challenging cycle. They aren't out there making wild, unachievable promises. They are acknowledging the great housing reset, focusing strictly on the productivity and digital initiatives within their control, and positioning the company to take market share regardless of the macro headwinds. Which leaves us with this final thought today. Run Lowe's through your own Buffett checklist. We see the robust cash flow. We see a durable economic moat forming with that heavy pro pivot. And we see honest, candid management. But with stagnant top-line guidance and real margin compression, is Lowe's currently a wonderful business sitting at a sensible price for the long-term investor? Or is it a value trap, just dead money waiting around for the housing market to finally thaw out? You'll have to apply your own margin of safety and decide for yourself. Thank you so much for joining me on this explainer, and keep learning.